it happens.
There
now. I just got a button that says the session is being recorded now. Okay.
So we'll
yep, there it is.
We'll leave the green room part of it in it here. Yeah, it was a good year, guys. Not to steal any thunder, but we had a really strong collective performance. The awards will speak for themselves. Kim did decide to share this year. I already sent her a note. She couldn't join us here tonight, so I sent her a note of deep gratitude for allowing some of us to have a statue or two this evening. Because she had a pretty good year last year.
Yeah.
And not to let any cats out of the bag, but I had a pretty good year.
A blind squirrel gets a nut every now and then, Mark.
You can take over the world with enough blind squirrels if you get them arranged in an army.
You can win elections too. So
that's right.
I'd march into war with this set of blind squirrels every year. So.
Yeah, and we've been actually seeing some pretty interesting ideas come out of the groundhog contest. Ken was just talking about the NVTA. Is that NVTA is the ticker symbol? I think that's right.
I'm checking my notes here. I don't see it in my notes, Mark, but it's the company is INV. The company starts with an I though. Yeah.
Yeah, the symbol's NVTA.
And that's a very early stage investing, so all the disclaimers apply, but I'm sure Hugh wouldn't be afraid of it.
Only if it has earnings.
I think it's pre-earnings. Why make it a challenge?
No, it has no earnings of any kind, guys. So.
Yeah, so there's a few that have been picked up, and I'll be adding coverage on a few more that are in the list. Had a couple people get a little more creative this year. Sandy Castor is near the top of the standings with some about half and half, some very unusual picks. But I think Herb's family club, his extended family club that's made up of the kids in the family, is the one that's actually leading the group entry so far.
Yeah, my family club is in second, or at least it was in second when I last looked. So
still is. I'm looking at it right now.
Is it?
Yep.
It's riding on Lemaitre Vascular.
Yeah, and the performance of some of those smaller companies that we've been talking about for a few months, and we were really strong on in December. I'm almost hesitant to bring it up because when I brought it up last September, I caused the crash in the stock market. But we went from like 49% with our best small companies for last year, Ken, and that went away in like 2 months. It was just
a lot of stuff disappeared by Christmas Eve last year. So
last year was a rather interesting year. You had an all-time high, a correction, a recovery on at least one or two indices, a bear market, and then I guess the recovery's been this year. So.
But yeah, and we're going to look at a slide that shows the reflection bounce back. It's amazing. And I don't know how many people I talked out of running for the hills in December, and I'm very glad that I did.
My only regret is I didn't have more money to invest.
That's the camp we were in.
I'm getting a message from Joe out there. He says, we, the HOC, has had some unanticipated changes with GTM. I assume that's GoToMeeting. Joe, I'm not familiar with what HOC stands for. Maybe one of the guys can enlighten me here.
The only thing I can think of that's close is Heart of Illinois chapters, but that's HOIC usually.
Yeah, unless it's Heart of Oklahoma.
Maybe.
Oklahoma City, I don't know.
Yeah.
Because you're talking about Joe Whitaker?
Right, uh-huh. Yeah, Joe, if you could type in the question box what HOC stands for, or let me know if that's just an error and it should be something else. We haven't had any major Heart of Oklahoma. HOC, Heart of Oklahoma. Oh, okay.
Heart of Oklahoma chapter. The C is probably for chapter.
Okay. All right. And we haven't had any GoToMeeting issues with our GoToMeeting license, so I don't know what to say. What kind of issues have you had, Joe?
Well, we had that caching issue that we apparently have solved.
We had some registration problems that they logged me in, took a look at it, and weighed in on and got solved for us.
Well, I'm showing 829, so we can best.
Okay, well, let's get started then, Mark, and I'm going to monitor all this stuff, and I'm ready whenever you are, so go ahead.
Okay, let's go ahead and get underway. All right, well, welcome everybody to the February 2019 edition of the Roundtable. This is our annual black tie gala red carpet edition where we take a look at, again, a snapshot of some selections made over the last year and also keep another eye on 9 years of trailing performance. Many of the people that are on this slide are with us here tonight. Kim Butcher's unable to join us, but I am joined here by Ken Kavula. I'm pretty sure Herb Lemkool is probably online. Cy Lynch from Atlanta is with us. Susan Michellik is often in the audience along with Ann Manning. Hugh McManus is joining us. You're back in California, right, Hugh? You might be muted.
Yes, I'm actually down in San Diego for part of this week.
Well, welcome back. We're glad you could escape back from Europe to be with us. And Nick Strategos is here from Pittsburgh. Say hello when you're from our favorite Penguin.
Hello there, everyone. Welcome.
And Mark, both Ann and Susan are in the audience.
All right, so we've got a pretty good group here. These people have all served as knights and damsels of the Roundtable over the last 8 or 9 years, and we've had a pretty good time. Without any further ado, we'll go ahead and get going with our celebration. We'll get the legal paperwork out of the way first. No investment recommendation is whatsoever intended. This is all about demonstration of the principles and practices of the modern investment club movement as interpreted by the NAIC Better Investing and or Manifest Investing. We will be talking about real companies in real time. Please do your own homework. Don't run out and buy something just simply because we whisper a ticker symbol at you. Do your own homework. We will try to disclose if we actually do own some of the holdings in our personal portfolios. If you have a friend or a family member in mind that you'd like to get an invitation to these events, please email nkavula1@comcast.net. You'll be added to the mailing list. Natalie will not inundate you with emails. She'll simply help to remind you when we're getting together to talk about educational topics related to investing. If you have any follow-up questions that we don't get to, or if you want copies of the slides, please feel free to email me at markr@manifestinvesting.com. So with that, well, let's launch into a fairly active agenda for tonight. It is the night that we hand out some golden statues, so we'll do that here in a second. I'll talk about what we've been doing here for the last 9+ years. And we have a few challenges to the existing portfolio. You will see stock presentations on Align Technology, CVS, Total, Ardelex. I'm going to double down on CVS, and we do try to leave some time, although we'll be a little bit strapped tonight for time. But this is our standing agenda that we use every month, and been having a lot of fun doing it. So with that, big welcome. to all of you, especially if you're joining us for the first time. We're going to talk about some of the stuff we've been doing for the last few years. And again, I just want to tip my hat and say thank you to all the knights and damsels in attendance for some really strong efforts here over the last several years. It's really been a lot of fun, and I'm sure it's been quite rewarding for many people in the audience too. Here's a reminder of what we do try to do. We do these webcasts monthly. They are generally on a Tuesday near the end of the month. And the whole idea is to talk about investing topics that we know are important to many in our long-term investing community. And we do try to single out a few of our single favorite investment ideas for further study. And we do measure our progress versus the benchmark of the Wilshire 5000. And we'll actually show how we're doing on that here before we leave. All right, so let's go ahead and talk about it. I'm just going to whisk through a few slides here. We usually do a lot more drum rolls and drama and all that kind of stuff, but for tonight, I think we're just going to just lay out the facts. The best selection made over the last year was by our friend from Pittsburgh, Nick Strategos. His selection of Five Below has actually appreciated 74% since the time it was made. And in fact, he made that selection twice. The first time at the National Convention in a live version of our roundtable, and then a follow-up online display. So a tip of the cap to you, Nick. Any comments or?
Well, in accepting this award, I'd just like to thank all the little people, especially the preteens that shop at Five Below.
That's right.
So, and I will disclose that my daughter does own some shares, and that's why I brought it to both the conference and back to the roundtable in May.
Well, congratulations on your first Golden Knight, at least in this category, Nick. And
thank you.
You can see the history there.
Mark, I'd like to know why I didn't get mentioned on OLED here. You and I brought that back on the in 2018 together on the same night. You know that?
Yeah, but you're talking about a different time and decision. This was my renomination of it a few years after the time you're talking about. So this is
okay.
I mean, remember, the two of us brought it along with the audience. It went from 80, it went up to like 240. And in fact, we actually basked in the glory of that probably a year or two ago. And then the stock price went back.
I'm just stating for the record that I never win any of these arguments with talking to the auditor of any of these contests. So I accept your answer humbly. Okay.
Yeah, I'm just saying this is not your father's OLED. This is a different version, but the audience did go along for the second time, so the audience are into this one twice. So you can see the performance of some of those top picks. Alarm.com, which I caught a little bit of grief for. I usually catch a little grief no matter what I do. So it's really been a pleasure to see Alarm.com perform so well. And then we see the Altas and Ardelyx, by the way, that's in 1 month. We'll talk about that here in a few minutes, but Ardelyx is actually on the leaderboard after just 1 month. And it came within an eyelash of having the best performing stock and the worst performing stock at the same time, believe it or not. Unbelievable. All right, so those are the ones for just last year. That's our snapshot. This is probably even more important, the best selection all time. And Nick, your pick of Five Below stands the test of time. It's still a live pick, so you can see that it's hanging in there pretty good. The ones that are highlighted and yellowed out are actually closed out positions, so those numbers are literally frozen in time. The ones that are not highlighted are still floating around with the turbulence of the stock market, so they can go up or down from where they're at. But again, second Golden Knight to you, Nick, and really strong performance.
Thank you very much. I appreciate it.
And I gotta love the Stanley Cup making an appearance on the pages of an investment presentation.
Absolutely.
All right, just pressing on. We also keep track of. We do like to beat the market, and we keep track of how well every single selection does versus the market. And the best accuracy in terms of the number of picks that actually outperformed the market was me in 2018. Kim may have been on fire in 2013, but I'm going to take the Enfuego 2 title for having quite a few picks actually outperform the market last year. And when you look back over the multiple years, Kim still holds the highest aggregate or composite accuracy. And you can see that a number of people have chimed in there and been involved in that award over the years. So 2 more Golden Knights. And then this one was a tough call because I like the little people too that Hugh was talking about, or Nick was talking about a few minutes ago with Five Below. But I went back and looked at the amount of correspondence we had, and one of the things that Hugh, we are most grateful when you're able to join us because you have a knack for turning a presentation on a stock into a really cool educational session. And in this particular one, you went in and you talked about the FDA pipelines and milestones and all that. And a lot of people said, wow, that just helps so much to understand, especially some of this early stage stuff. So again, on behalf of a number of people who wrote to me, I know I sent you some of the notes. Thank you for that contribution.
Oh, thank you.
And then a lot of these are available on YouTube. You guys can go to YouTube and search Manifest Investing Roundtable or something along those lines, and you can actually access these presentations. I still think the more Spock and less Kirk is absolutely timeless. Back in 2011, the other ones are good too, but that's a really good one to check in on, especially if you're out there and you're in an investment club. And, kind of like back in the fourth quarter of last year when there was a whole lot of fear in the stock market, Hugh's entire session is about how fear can rip your heart out and turn you into an average investor if you don't have a way to handle it. So I would recommend that if the next time you want to get together with your club partners over this notion and this topic of fear, that 2011 presentation is absolutely a classic. All right, so let's go ahead and press on. Again, best performance last year in terms of overall performance. Well, when you have nearly 4 out of every 5 of your selections beating the market, you end up with your picture on this slide. The highest relative return, I knocked it out of the park. I believe that Cy was talking about modestly. I mean, look at the selections on here, guys. I mean. You guys have been, giving me a hard time about not carrying this group, and I almost hesitate to use the expression, but yeah, I kind of helped to carry this place, here the last year or so. There's some pretty good selections there, and the audience joined in on a few of those. So, from top to bottom, some really good ones. I mean, Skechers. I remember. I was sick to my stomach making that presentation because I didn't necessarily believe it, but look where Skechers ended up. So, some interesting picks along the way. So I did get in there for at least one trophy. And then last but not least, again, over the long term, we pay attention to the things that happen for a single calendar year, but more importantly, this is true in our stock picking contests that we do in our chapters across the nation, the groundhog and all that kind of stuff. It really is the all-time performance that matters, that career record. And our friend, the Irishman, is back on top in this by a nose over Kim Butcher. But again, when you do something like this over 9 years and you pick things like General Electric 5 times and you still have an 18.7% overall return, that's pretty special stuff. So I know that there's a lot of people out there cheering for the type of stuff that we're doing, and Hugh, you bring some interesting ideas. So once again, we just like to say thank you, and you'll need again a bigger trophy case. All right, so with that, all of that performance over the last several years does add up to the chart that you see here. This is the relative return for the collective performance of all of us since the beginning, and we are sitting at about 17% for absolute return. That's beating the market by 7.5% over the last, coming up on 9 years here pretty soon. Pretty special stuff. More than half of our picks have actually beaten the market, and it's not just fun. I think there's some rewarding going on in there too. Any questions or comments on this at this point, Ken?
I really think that I'm focusing on this outperformance accuracy, and to do better than 50%, I think is quite a feat. I'm very, very pleased with that number, and of course, I'm pleased with the 17% overall. I'm not sure that any of us thought we'd be there back in 2003, 2004, when our numbers were down around zero. You know.
Well, that's before I started carrying my load. Anyhow, some good stuff. And again, we do take what we do here fairly seriously. We do try to bring good ideas. Again, do your own homework, but the numbers have been pretty good. Again, one of the things we want to do is spend a little bit less time on slides like this. These are the 20 stocks that are the most influential in the portfolio. You'll see a number of common household names, but there are some exceptional picks, the Amazons, the CVSs of the world. And again, just real quickly, the number of times that a stock is picked is up at the legend at the top. Every time a stock is picked by a knight, a damsel, or the audience, we invest $1,000 in it. So $15,000 has been invested in Cognizant Technology, probably 14 times by Cy Lynch, and that is now worth $25,000. So that's how you can decode that. You can look at that portfolio. All of the selections, all the active selections are available at that public link at the top of the page. All right. Here's just a quick reminder of how. That wasn't a speed bump. It was a speed bump on steroids back in the fourth quarter when the stock prices dropped and the potential from stocks known as the projected annual return for the aggregate of stocks actually went up to a multi-year, almost a decade high back in that fourth quarter, which you can see on the right-hand side there. Amazingly enough, in a very short amount of days, what was it, starting on Christmas Eve and continuing until now, we've actually bounced pretty much back to where we were pre-correction, pre-bear market. So that's actually quite a vicious speed bump on steroids. All right. Here are some of the challenges we want to talk about to the portfolio. We're always looking for more growth, more return. One of the things that we monitor, first of all, is any stock that may be, speeding ahead, maybe getting ahead of itself, such that its return forecast, known as a projected annual return, becomes low. Low for a good reason. If the stock is performing very well, we actually don't have anything anywhere close to money market rates or zero, so I don't think that there's a real challenge candidate based on return forecast at this point.
The only comment that I might make, Mark, is that I would really like to see our sales growth moving, in the upward direction. So if we had to do something, the two real low sales growth numbers might be numbers that gave us the at least to take a second look at freezing their positions. They're both growing at less than 7%.
Yeah, and that doesn't ding us too badly. We'll see some other ones here in a minute that actually do that a little bit more. But a return forecast in the 6 or 7% range is pretty close to the market average, so it's kind of hard to attack any of these. All right, and then the second form of challenge that we've been talking about here over the last year is the rule of 5 based timeout condition, where a stock, for whatever reason, just simply lags the market by 20%. Now, the Ardelyx gets a pass. We just deem that to be a speculative swing for the fences. And as is shown there, Hughes' first selection was made at a price of $10.91. So when that dropped down to $2, that was a bit painful. But again, it's just something that's part of the deal. We just kind of ignore those. We do have an Alliance Data Systems position that is now down to minus 30. And then a couple that kind of surprised me. Western Alliance has actually had quite a dip. And Cambrix is actually, and we're going to talk about Cambrix here in a second. So again, I think these are some we might want to think about giving a timeout to.
Well, I'm willing to make the move or to talk about the fact that we're in the middle of an experiment. We might as well continue with our experiment. I think that the fact there's two more ADS appearing on the list after we removed one last time and one 3 or 4 times ago might be indicating to us that when you're going to take out one, you might as well take them all out. But
have we taken any ADSs, or have we deferred because of that?
We took
issue?
out 1 or 2, and we deferred while we were debating. I think that top position shown here that was purchased at 251, that's the one that we were kicking around because it was around 24%. Now ADS has actually gone down in the last month while the market's advanced pretty handsomely. So, I mean, we're still seeing, who knows, longer term, but we are seeing some fairly significant weakness, at least in the short term, on it. All right, so let's go ahead and move to the third thing that we do want to watch and monitor, because I think Cambridge actually falls in both places. It's qualifying for a timeout. And then Ken, would you like to discuss the type of thing we're looking at here?
Yeah, we've begun looking at quality ratings to preserve long-term capital gains as well, and we've theorized that a drop in quality, a significant drop of maybe 10 or 12 percentile points or more, especially from somewhere around 80 plus to 80 minus, it might be real reason to sell. We've been doing that, and so far we haven't had any stock that hasn't shown us that probably is a decent idea to preserve some capital in. There's 4 stocks that I just brought that have the same kind of quality graph here. Cambix quality was kind of moving in a sort of an upward bias when we bought it. It was up around 85, 87 when we purchased it. And it's now moved down to something around 40, 50, 49, there it is, 45. So I would, 2 of these are mine, Cambridge and CBRE, and with the drop in quality, I would indicate that's telling me that I want to move out. If you remember when we did presentations on this, we indicated we probably had 3, 4, 5, 6 months to move out of a stock once its quality dropped before we saw the price start to move with the quality. It looks like with Cambridge right here, the price started to move with the quality pretty quickly. It looks like the quality moved down at a kind of a high price, and then it's been moving down ever since with a slight bounce back in January. So I would at least ask to remove Cambridge and CBRE from the chart. NetEase, I think, is a whole different animal, a whole different situation. I don't think you can find 2 analysts anywhere in this country or that follow this Chinese gaming stock that agree with what it should be doing. The growth values, the sales growth values are in such a wide range that the average number that Better Investing, that Manifest Investing's analysis is based on, probably is not as good a number as we would anticipate for most of the stocks that we cover. Some analysts think that this company has virtually no potential growth left, and some analysts think this company has 30, 35, 40% potential growth in sales left. So we're looking at that 22.5, but that represents an average of really, really widely spaced numbers, which means that we're not getting a real good analysis of what this company may or may not do. Mark, I'll let you speak to Roche.
And I'll wrap up NetEase a little bit. I mean, I own some of this. It's in a part of my portfolio that I really don't pay that much attention to. I consider it sheer speculation. It's money that I don't ever like to lose money, but I realize that this is speculation. I'm intrigued by the growth possibility, and then I also remind that this is a single-time selection for the roundtable, so it's only $1,000 invested over the past few years. I'm not even sure, I think Cy Lynch brought this one, and it's up to almost $5,000. I just think that I think the turbulence is just par for the course for a company like this one, and I mean the growth doesn't bother me. Cy, any thoughts on this one? I know you.
Yeah, I own a little bit of it personally, as well as follow it with the my Better Investing Growth Stock Outlook column, and I almost sold it with the quality degradation a while ago. But what has happened with the NetEase, and I'll just throw this out as I agree with everything that Ken and Mark has said, but the actual drop in quality occurred rather dramatically back around, let's see, looks like June of last year, and there was a fairly precipitous price drop not long after. But the price has significantly recovered and is just about back where it was when the quality dropped, and quality has stabilized and even slightly gone up. So even if it was a good sell for quality degradation 6 months ago, I'm not so sure it is now. So this is one of those that's probably like, although Artilex doesn't have earnings and bounces around for somewhat different reasons, this is probably, like Mark said, just one of those speculations that bounces all over the place.
All right, and as far as Roche goes, and Hugh, you can back me up on this. I mean, there's nothing wrong with this company. European recession's probably hurting them a bit. I picked it over 8 years ago, so it's been in the portfolio that long. It's a single-time selection. We're talking 8 or 9% a year. Nothing incredibly sexy about that, but we're also not afraid to be bored by some of our investments. I do worry a little bit about the lower growth rates. This is a fairly mature company. Any global perspective on Roche, Hugh?
No, Roche as a company is doing well. I think the jewel that it really has is Genentech up in the Bay Area. That's feeding in a lot of molecules and large molecules, particularly into this pipeline. So Roche isn't going anywhere. It's, a significant company in the pharmaceutical industry.
Yeah, well, and part of me is there's selfish pride involved here too. It's one of my oldest selections, and I feel like there's a conspiracy out there trying to get rid of all my good baseload selections so that you guys can dominate me in the contest. But no, I'm kidding. I'm kidding. And the part of Mel Gibson tonight is played by Mark. No, with that, I think I'm good with dismissing Cambrix, but I think I would hang in there with Roche for a while, and NetEase, and CBRE is kind of a coin toss for me.
Well, I'd like to follow what the experiment is that we're doing, so that the two that I've chosen, I would like to see us freeze those positions, Cambrix and CBRE, and then my instincts are to follow what we said on our experiment for the relative return number as well.
Okay, we'll go ahead and process those changes, and we'll press on from there. All right, so with that, I think we're doing not too badly on time. We're under the first half hour. Go ahead.
Just one question on the relative return numbers for so the ones that have multiple. Well, I guess since Artilex is getting a pass, I guess that may be the only one other than ADS. So we're selling partial positions, not the whole one.
Yeah, I still want to go with that form of the experiment. I have done a little bit more looking into partial lot selling. I'd never really done much of that. I don't think many people do. But Bivio, we published some work from Bivio on partial lot identification, and I actually have a partial lot transaction in my personal portfolio stuff for the first time in a very long time. So
And again, ADS is my pick, and I'm not particularly in love with it emotionally. I just have problems when you are making a market sentiment or quality decision. To me, it should be all or nothing. A valuation sell, I understand selling partial lots, and I have done it, and logically it makes sense. But to me, a market sentiment decision, which is what I see the relative return things as, or quality, it should be all or nothing. And Ardelyx is a good example. If we had sold Ardelyx a month ago, of course, Hugh would have bought us right back in it. But I mean, that was the best performing stock. That's the best performing stock in a month.
Yeah, absolutely.
So, like you said, it's sold more. So it's both performance. I mean, so Ardelyx is again an example of a. Now, again, I understand that's the speculation, but that is an extreme example of you had both a best and worst performer.
Yep, no doubt.
Stock.
Mm-hmm. Yeah,
so it's either a sell or a not, in my view, theoretically. And again, I realize this is an experiment. I realize we're trying to develop it, and of course, I also will admit my bias that I'm not convinced the experiment over the long term will end up good, because some of our best buys are, buying a company the month after we would have sold it had we owned it, because that's what we're doing. We're going against the market and the market sentiment.
Mm-hmm.
Now, ADS, from a company standpoint, its future prospects have also been declining. So it's a questionable holding. I mean, I can see it being sold, but again, I just don't understand partial lot selling for quality or for relative return.
Yeah, it's a fair perspective, and it's a perspective that's shared by a number of subscribers and investors out there. So,
if I could just throw something in too, I'd almost like to see the eagle, so that we could see that if there is a declination in the quality, and like Cy said, make a decision based on that, and do an all or nothing. Because I think ultimately it's that quality that seems to be driving some of this experiment. And so I just like to see it as a comparative for the all or nothing, or just sell the lots.
Okay, I'll chew on that. Sounds good. Anything else, guys?
Mm-mm.
All right, let's go ahead and press on then. Our first presentation tonight is, I guess for some of the little people, right, Nick?
Yeah, back to the little people. Some of the teenagers here are going to be some of the clients that are involved in this company, Align Technology, ALGN. Go ahead, Mark, move ahead. This company, a couple of things of note right now, it's on our best small companies list this year that was put out Halloween time. It also turns out that this is number 6 on the heavy hog list this year. So go ahead and move it forward one, Mark. And really, it's all about everyone deserves a smile they love. That's what Invisalign is. Invisalign braces, or really, they're really devices. They're not truly braces, or what they do. They are a global medical device company, and they are industry leading by their innovation. They really have 3 products. The first one is the one that we all know, the clear aligners, the Invisalign product. They also have what's called the iTero intraoral scanner, and that's a piece of equipment, and we'll go into a little bit more in a couple of minutes, but it allows a dentist in an office to be able to take a digital scan of your mouth and be able to recommend treatment for you. And then they also have something called the OrthoCAD, which provides digital services and allows the dentist to take that one step further and achieve positive clinical results from the iTero intraoral scanner. They are able then to deliver cutting-edge dental options for the process. So go ahead. This next slide is an example of what happens as you go through the Invisalign process, and really using all 3 of the products. You start out with a questionable smile in your face. They're able to work through some issues with the ortho, and then they can ultimately give you a smile that you love. So go ahead, Mark, one more slide. Their overall vision is to bring clear aligner orthodontic treatment to the masses. They are in 103 countries, and they have been the pioneers in the invisible orthodontics market. So far in their history, they have helped over 5 million patients develop a smile that they love. Go ahead to the next one. one of the things when you look at a company, you want to understand how they're going to grow. And for Align, they really have 4 key strategic priorities. The first one is the international expansion. We've talked about the fact they're in 103 countries. Go to the next slide, Mark. This is a picture of where they're at. They're all over the world. They also have facilities in Mexico, Costa Rica, in Europe, and they just are opening in this really the end of 2018. They opened a new facility in Zhejiang, China, where they are now able to produce the invisible aligners. Go ahead to the next one. They're looking to expand their market share too by providing results to many people. The overall share of the market is something like 12 million orthodontic cases every year. Invisalign is applicable to about 8 million of them. Right now, though, they don't have that much of the market. They're only in 14% of the market, and about 40% in the adult market, and that's understandable. My boss went through Invisalign, and as an adult, you don't want to have the braces in your face. But the teens is where they're starting to get a hold. They're up to about 6% market share with the teens as it becomes a viable alternative to the traditional wire braces. Go ahead, Mark. Next one. This is kind of their process they go through. They work with the iTero scanner where they develop the digital picture of your mouth. They then provide you with the invisible aligner. You go back to the dentist, they check again, and then they adjust it, and then they provide you with new aligners. Ultimately, they get you into retainers at the end of the process. Next slide. The iTero is a very interesting tool that they've developed. In the last about 3 years, they've gone from 1 million scans to nearly 10 million scans. What it is a chair-side platform to do digital diagnostics and provide treatment tools. It allows them to do a scan of the mouth and really provide not just the invisible aligners that we've heard about, but they also can do crowns and bridges. They can also do full or partial plates or orthodontics in your mouth. They can do veneers, and then they can do implants. And a lot of the teens, and I know I have with my kids, all 3 of them when they were teens had veneers put on. The best part of it, though, is it provides an outcome simulator. And then they're able to send that digital scan to the dental lab so that they can produce your Invisalign or your implant or your plates. Next one. They're taking this to the next level. They're going to start providing 2 more services. They're going to have what they call the Smile Concierge program, where you're going to have someone at Invisalign, at Align, who's going to walk with you down the path, whether it's a professional in the dentist office, that's where they're going to help you out. But they're also starting to go to a storefront. So they're going to start putting storefronts in malls. They're going to be able then to do this on a temporary basis. Right now, they have 12 locations in the U.S. The 12 locations are serving about 55,000 visitors. And of those 55,000, 10,000 have taken advantage of their complimentary iTero scan and simulation. So again, with this iTero scanner, they're able to see the outcome right there. Then they're able to then connect with their local doctor. So go ahead, Mark, to the next level. And this is basically when you walk into the in-store, this is what you get. You get the scan, you get to preview your new smile, you get to pick a doctor if you choose to do it, and then they also help you finance it because like any other medical procedure, there's a price to it. So they're able to do that all right there. So that's what they do. So let's talk a little bit about how they're going to grow. So Mark, the next thing that I have here is that the management has a target in 3 to 5 years. They want to continue to grow their revenue year over year between 20 and 30%. That's a pretty significant margin. And I love it when I can find companies that management is targeting 20% growth on the low end. Go ahead to the next one, Mark. They had some issues in the 4th quarter, and I wanted to share this part of the value line with you. In the 4th quarter, they had some cost issues, and this is one of the reasons why the price dropped, is that they did not meet the street's expectations. They had some additional expenses related to the transitioning of their production facility from the Juarez, Mexico plant to the new plant in Zhejiang, China. So there's some additional costs that came up there. They also brought on 100 new salespeople that are working now to target general practitioner dentists. They're not your orthodontists. These are just the guys you go to for your cleaning, but they're targeting them as the kind of the first step to work down this path. So by bringing those 100 on, obviously they have costs related to the new hires, and they don't expect to have a lot of productivity from these new hires until maybe the third or fourth quarter of 2019. Ultimately, long term, which is what we're looking for, this is going to be a great thing because you're going to be able to hit those target of 20 to 30% growth. Go ahead to the next one. We always want to see up, straight, and parallel, and certainly while it was a little bit less than parallel in the early years, over the last 4 or 5 years, not only have the sales been up and straight, but everything else has been traveling along with it, including the price, which ran up a bit in the last couple of years. So go ahead to the next one. I also wanted to take a look at the quarterly, and the solid green line represents my sales growth estimate. And I chose 20%, and I'll talk about that in just a second. But that 20%, you can see over the last three and a half years, their trailing 12-month sales as well as their earnings have been above that 20%. So I feel pretty confident in this management of this company that they're able to make that 20 to 30% target really happen. Next slide. I went ahead and picked the 20% as my sales growth. I really based that on the management's low end of their expectations. When I looked at Value Line, when I calculated their sales, they're expecting about 22% growth. Makes me feel warm and fuzzy. When I looked at some other potential analysts and what they expected, their earnings growth rates went anywhere from about 23, 24% all the way up to Morningstar's predicting 30%. You can see that I didn't do that in my earnings per share number. I left that at about 19.7. I also feel pretty good about the management categories on the stock selection guide. Pre-tax profits have been pretty much stable over the last 5 years. Good solid return on equity, and there is no debt. Go ahead to the next slide. Looking at this again, I think that this price drop that happened at the end of the year in October, November timeframe really gave us an opportunity to jump on this stock, and I think that's reflected in both this fact that it ended up on the small company list as well as number 6 on the groundhog. Go to the next slide, and this is the graph. You can see that it's a very high quality company. It's been moving up, and it's up at the very top now. It's a 99% quality company. That price that dropped there at the end of 18, you can see has given us now a par that's around 16. So I think that this is a great company. Also on Value Line, their low total return expectations about 8%. Their high total return expectations around 20%. So go ahead, Mark, to the last one. Right back where we started. Everyone deserves a smile they love, and I think so does the Roundtable portfolio. So I recommend that we add one helping of Align technology to the portfolio.
Well, thanks, Nick. That's one that many of the people in the community have been tracking pretty carefully. Ken, this was one of the best performers in your chapter stock picking contest, wasn't it?
Mm-hmm. I will add 2 other things. Number one is that I did bring this same company in 2016 to the Pittsburgh chapter when you guys were out for our event. This was the one that I recommended, even though Pat went off the board somewhere to some food company. And it turned out that in 2016, this was the S&P's best performing company.
Right.
The other thing is total disclosure, I own.
Okay.
So I own, and my wife owns, and my sister owns.
All right, good stuff. So with that, we'll turn to Cy in Atlanta and quick look at CVS Health.
All right. I will try and keep this fairly short since we are have a long program, and most of us, I think, know CVS, the company, and really what I wanted to focus on was what's new with CVS and what's going forward. Here you see the historical CVS, which is certainly a good endorsement of management, but from a number standpoint, you can throw away and forget because it's a totally different company today. Next slide. Here's how I found CVS this month. I just took a look at the portfolio, saw that CVS was the highest in our green zone without going into yellows. And I've been kind of looking at CVS and also the fact that they had closed the Aetna merger finally had me intrigued as well. So that's why I decided to go with CVS. Next slide. Did as I usually do, and Manifest is wonderful for allowing us to be able to do a quick industry study. Again, you see CVS is the only healthcare plan industry company that has both excellent quality and a green zone return. In fact, the only return above 5 MyPar plus 5 with excellent quality. Next slide. And here is just a visual depiction of the new company. Combining CVS and Aetna has the retail, which is the traditional CVS, the pharmacy services, that's the PBM part that the Caremark merger added to CVS and they've developed, and then the healthcare benefits, which is what Aetna brings in. And if you dig into company presentations and so forth, they are realigning some of their reporting to bring together the PBM in particular aspects of pharmacy services and healthcare benefits between the existing or the previous CVS and Aetna, but that's beyond what we really need to worry about tonight. But next slide. This is the company's vision on what they are trying to do. And it's one of those things that it will prove perhaps to be brilliant, or it may prove to be very faulty. But this is how the company presents the current system. You can see their chart. They have high costs, inferior outcomes, and they say that it's ultimately unsustainable and needs to be transformed. Here's the way they want to transform it. Next slide. They bring the consumer into what they call the new front door. Essentially, CVS Health will be the consumer's entrance into care and will cover all aspects. You saw the 3 aspects: the pharmacy management, the healthcare insurance side, as well as the retail side. And their goal is to improve the engagement of the consumer, improve outcomes, and lower costs. Next slide. This is their view for from a shareholder's perspective. By creating new healthcare programs, by simplifying patient journey, they hope to drive enterprise growth and, of course, long-term stock value creation. Next slide. This is words for what we'll see in a couple of the next slides on charts, but kind of the big picture details of how they want to achieve some of this. As a company, they're moving away from their dependence on pharmacy dispensing. They do want to expand their Minute Clinic services. That's part of that front door that you saw. That Minute Clinic be the entryway into health treatment that many customers will go through. And then from the managed care perspective, and this is something that the government is looking at all health care providers, health insurers on, as well as hospitals, but seeking to prevent hospital readmissions. And not only is that obviously good for the patient, they're hoping, CVS hoping to save more than $3 million a year in healthcare costs and costs to the company if they can reduce hospital readmissions for their patients. Next slide. Here again is kind of their buzzwords for how they're looking to improve this patient and customer engagement is local, simple, and improving the health. And again, then you've got on the right-hand side some of their details. I've already mentioned the readmission, but they're also seeking to optimize primary care, which again is the Minute Clinic or Minute Clinic Plus, and some other. They actually have a specialized store they're developing that I don't think I have a slide on, but that would fall into that area, as well as chronic disease management, which that again is one of the things that all health insurers are really looking at and trying to improve, and bringing it all under one umbrella, as CVS has done, they hope will help them do that better. Next slide. This is just more words on what specifically they are planning to do to save costs, not so much in 2019, but in 2020. That's why they call it post year 2, 2020 and going forward. Next slide. And I'll go ahead and mention on this, there are two, if you go to the CVS Health website, these slides have been taken from their latest investors presentation, which covers the merger and the vision, what I'm calling the vision aspects, and then the first quarter report has some of the actual projections and details. You can get a lot more detail if you like on this if you go and look at those two presentations. Then again, this is more detail on chronic disease management, and again especially the readmission prevention, and again the advantage they have over most of their competitors and people with different models is they combine now both the managed care hospital experience as well as the potential minute clinic follow-ups that they're talking about. Next slide. And then back to the shareholder vision is increase customer base, the healthcare reach, essentially sales, then save money with synergies from the merger, but then ultimately long-term healthcare savings, and then they're hoping to accelerate their long-term growth and turn a very mature company into a faster growing company to drive shareholder value. Next slide. The biggest question that I would have with CVS, they funded much of the merger with debt, although it also was largely equity funded. And here is their debt schedule over the next roughly 20 years. And their plan is to keep dividends flat, and they have suspended share repurchases until they work on paying down the debt. Next slide. Here is more detail on their plan for paying down the debt, and they're shooting for a debt to equity or adjusted equity EBITDA. Actually, that's not an equity figure. That would be an earnings figure of 3 times is their aim. Which again, realize that insurance companies have a very high debt level. So while this may look high from a retailing level, it's not nearly as high for a insurance company, but they're seeking to pay it down to a more reasonable level. Next slide. 2019 headwinds and tailwinds. I'll let you read that either now before we jump on or in the replays. But again, generics have been struggling, and but things that have been good is that their prescription growth is outpacing the market, and they got good specialty growth. And then, of course, they believe the Aetna business and government, that being primarily Medicare, but some Medicaid policies as well, will drive revenues and performance in 2019. Next slide. Here's some specifics on the projections that they for 2019 that they're looking at. You'll see GAAP earnings per share, they're expecting to slip a little bit. That's primarily because of the increase in shares outstanding from the merger. Revenues are going way up. But of course, again, the margins on the insurance side of the business is much lower than the retailing side was. Next slide. This just gives some projections. Once we get a little bit more consolidated figures going forward, the projected tax rate, the impact of the issued shares. That's about a 30% share increase, 30 to 40% over what it was that they're looking for, at least in 2019. And then I did highlight the cash flow, and that just the free cash flow, that being the cash flow from operations less capital expenditures, is sufficient to cover the debt through 2020 and most of the next 30 years. So their debt, while is somewhat high, they're working on paying it down, and they have plenty of cash flow to do that. Next slide. And then I just chose, since at this point in time, you don't have, other than relying on management's past ability to integrate mergers to include a fairly significant expansion into a new but related area, which was the Caremark PBS merger that CVS pulled off quite well. I didn't modify any of the judgments, and this is from manifest defaults and is based on the old CVS. It hasn't yet brought in the Aetna figures, which no analyst has yet done to a great degree. But I'm comfortable with the numbers as a baseline to get us started. And the two things that jump out at me here is a reasonably low PE of 12 will support a 17.6% potential return. And I also like the 2.8% dividend yield, which again, as I mentioned during the presentation, they have frozen the dividend for the moment while they're paying down debt, but they're not reducing the dividend. So I suggest adding more CVS to the portfolio.
Okay, thank you, Cy. Yeah, CVS is a 9-time selection for the roundtable, spanning several years, and so this will be the 10th, and I'm going to choose it too, so we'll be up to 11, and it really is, at this point, as Cy has demonstrated, a kind of a vote in the confidence we have in management. Certainly a tough issue going forward. So with that, let's go ahead and talk about a little energy. Ken, are you ready? Do we still have you, Ken?
Can you hear me now?
We can hear you now.
Okay, I was muted in two places, not one. Okay. I'm going to suggest that we add Total. It's a French energy company. I'm going to suggest we add that. It trades in the United States as an ADR. It's fully integrated along the entire oil value chain. It has a lot of production facilities throughout the world, and I'll show you just a little bit about that. It handles 70% of the refining in Europe, so it's poised to participate in Europe's rebound from the recession, I guess is a good word to call it, that Europe appears to be in right now. And it also has service stations and services that it markets throughout the world. So it participates in all different aspects of the energy value chain. It not only does oil, but it does a lot of work in gas, and it's made forays into alternative energies and into renewable energies, so that you're getting a really fully valued spectrum of different types of companies within this one name of Total, ticker TOT. Next slide, Mark. Here you see the different places in the world that Total either is presently working to extract oil and or gas, and then you see where they do different administration work and where they are targeting new energy exploration into the future, the next 3 or 4 years. Next slide. They're one of the top producers in the world. They have the best-in-class profitability, so that means they're more profitable than the oil companies that we might be a little bit more familiar with here in the United States. and they are very disciplined when it comes to spending CapEx money. They tell you what they're going to spend on capital expenditures, and then they meet those percentages on a regular basis. There's a very, very strong cash flow, and all of the material that I read indicates that that cash flow is going to be increasing significantly in the next 2 years. That allows them to increase their dividend. It allows them to buy back a fair number of shares, and they've been able to pay off some different loans and some different responsibilities that they had in a very economical way, and do it much sooner than anticipated. They have a very large portfolio of many different types of energy concerns. Next slide. Here's the chronicle from Total, and again, I like to see a company where the quality is on the upswing. It looks like it hit a low down there of around maybe 63 or 64, but the quality certainly has moved up, and I would guess just by looking at that number that it's somewhere around maybe 88 or 90 right now. I also like to buy a company when its par value, that's the red line, when its par value is at kind of a historic high. And I'm looking backwards on this graph, and those values right there are just about as high as par has been in the last 3 or 4 years. So I'm fairly happy with the quality and the par. Next slide. I went to Value Line next, and I discovered that this is a triple play. The double-digit returns at the high side and the low side certainly indicate that the stock price is a little bit under pressure right now. It's a little bit devalued from where you might expect it. And going forward, we're expecting from Value Line 14 to 19% appreciation. The current PE is actually lower than that 11.7 that I circled on top. That was the PE to match the $56 present price, but we're actually a little bit less than that. And you can see that Value Line expects the PE to move to the 12 range in the next 3 to 5 years. So that's the second leg. A depressed stock price is the first. Second leg is PE expansion or potential for such. And then I kind of boxed in the percent profit margin numbers, and you can see that the last year, 2018, that we have an actual figure for, the net margins were at 6%, and Value Line is suggesting that 3 to 5 years from now they might be at 7.4%. Mr. Nicholson indicated that when you have these three things happening, you stand a much better chance of finding a company that can make you some significant gains in the future. So we do have the triple play going on. I also like to point out that very rarely do I look at a stock that Value Line is suggesting has a 1 in timeliness and a 1 in safety. I always look at the safety number, but I hardly ever look at the timeliness number. So it's a curiosity to me. It's a pleasant curiosity that not only is this ranked best for safety, but it's also ranked best for year-ahead performance. That's what the 1 is indicating on the timeliness, year-ahead performance. Next slide. I'm looking at the graph. This is a classic cyclical stock, and the SSG is not an especially good tool to use to evaluate a classic cyclical stock. Look at that beautiful sine curve, S-I-N-E curve up in the sales up there, reaching a high, going down to a low, going back up to a high. We'd be buying it right at the right time, and that means you're buying it on the upswing. And the only thing you'd have to keep in mind is that you'd be trying to sell this thing once it hit peak and began to move in the other direction, because after all, earnings do follow sales, and stock price does follow earnings. I think right now this is yesterday's closing price of 56.49. I think it's an opportune time to be looking at an energy stock. I've been noticing for the last 3 or 4 months that my screens are filling with more and more energy stocks as I run my different screeners looking for stocks of interest. Next slide, Mark. On Manifest, I can kind of get a list of what's happening in those industries, and Manifest suggests that Total might have the best par in the oil and gas integrated industry, and that Total might also be the best stock in the entire energy sector. So I kind of took that into consideration as I was choosing a stock. The annual rates going forward, and I think Value Line knows that it's very difficult to predict flat annual rates for a cyclical stock, but then again, it is telling me 8.5% sales, 16% earnings out 3 to 5 years from where we are right now. This is a brand new Value Line. It's dated March 1st. That's this coming Friday, and you can read the last paragraph there. They're very positive, very highly placed when it comes to thinking that Total would be a good investment, making it a strong addition to most portfolios. I don't dabble in oil stocks very often. I don't like the fact that I have to watch this one closely and I have to be ready to sell it 2, 3, 2.5, 3.5. Whenever that cycle starts to turn the other way, I have to be ready to sell it. And I know oil well enough to know that it's going to make a couple of feints before it actually makes the action happen. So just following the price of oil isn't going to help me very much. I'm going to have to keep my nose to the grindstone and watch this one very carefully. But at the same time, I don't mind having some oil in my portfolios. I do own Total. I've owned it for about a year now. I have owned it in the past and sold it and then bought it back a couple of different times. Next slide. My judgments on my SSG, reminding myself that the SSG is a less than perfect tool to use for a cyclical stock. My judgments were as stated on the slide there. That gave me a par value of about 17.7. I checked the Manifest site. Mark's numbers coming from the analyst had a par value of 17.8. There's another coincidence. I don't normally get that spot on when I'm doing my SSGs, but in this case, the two analysis came down to basically the same number. I'm very pleased with everything that I've read about the company, so I suggest we take a position in Total.
Okay, thanks, Ken. Yeah, it's certainly a more challenging stock analysis, not necessarily for beginners, but again, we'll be fascinated to watch that one play out. All right, what I thought I would do is, first of all, I am going to end up with CVS, seconding size notion. CVS ends up pretty high on some of our screens, and as most of you know, took quite a haircut on Thursday or Friday. The stock price dropping, I don't know, 10, 15%. I put my hands over my eyes, I couldn't look. So CVS did take quite a hit. But what I thought I would do is just, again, go over the traditional look that we have of some of the more common stocks showing up in our screens and refer to this as the parade of opinions because we feature ratings from various different research entities. But you can see some of the names you've heard. Air Lease was featured by Kim a couple months ago, and it's a Matt Spielman favorite. They're having turbulence with some of the cancellations going on and the new business shifting over to Boeing, but very well-managed company that probably has pretty good outlook going forward. Facebook is in here. You can see that Nick's Align Technology is here. CVS Health is here. Total is here. So all the companies that you have heard about tonight actually make this fairly short list of companies that have exceptional return forecasts without being too greedy in combination with a decent quality rating that places them at the top of the stocks that we follow. Keep in mind that at Manifest Investing, we build a consensus using sources like Morningstar, Standard & Poor's, Value Line, and a few others. And we're basically kind of looking over that panorama, looking for companies that kind of have compelling or intriguing characteristics. One of our other favorite things to do is, like you, we'll often search for companies trading near their 52-week low. So we're looking for companies that are fairly close in proximity to their 52-week low. Well, with all the carnage going on at CVS Health, you can see it's within 1.5% of its 52-week low. So again, just kind of scanning across and looking for where we think the opportunities might be. See some fairly decent low total return forecasts from Value Line, including the one from CVS Health, checking in the upper teens. There's a few more here that have fairly decent outlooks. And then we also like to take a look at Morningstar and basically make a comparison between the current price and what Morningstar deems to be the fair value, or the price that the stock is actually worth. And so anything less than 100 is a company that is deemed to be potentially on sale by Morningstar. And just like everything else, you can get so low that it's too good to be true, so you want to be careful with that. But we do see a number for CVS that is now sunk into the low 60s. There's a bunch of companies here, though, in the 70s and 80s that could be worth further study also. Many of these have showed up in stock picking contests and have been recently featured here at Manifest. The analyst consensus fair value is also something that we look at, and you can, again, for comparison purposes, you can see that they are a little bit less optimistic than Morningstar, but again, fairly decent numbers for CVS Health, and for that matter, AbbVie is also another one that's a fairly decent study from the health sector. So, ranging from left to right, all of this stuff, including the S&P, all of these numbers here are the long-term forecast situation. We do like to take at least one eye on what the next year might hold. Again, hoping to catch a company with a little bit of tailwind, to use a Buffett expression from this weekend. And by the way, Berkshire Hathaway put out their annual report this weekend. If you're an investor, you should read it. So again, we're looking for companies with some tailwind, and again, CVS Health checks in with pretty decent expectations for a 52-week return. So that's why I ended up there. Again, just seconding the stuff that Cy had to say. You are going to see a company that's completely transformed. I don't know, Cy, if you did any looking for any pro forma information. We might try to bring some of that in the notes to this session. Pro forma being the combination of the old CVS company with the newly combined Aetna, and basically trying to look at some of that. Did you find any of that to be available?
I did not dig into it, but I believe it is the press release for the first quarter earnings did have links into pro forma, and I actually had meant to click on it and at least glance at it to see what was there, but I did not have a chance. But yes, if you go to the website, you can find the pro formas.
So a lot of times when you're looking at that, again, that's just combining the two companies with just kind of mashing the numbers together just to see what that might look like. There's no way to know what type of eliminations and synergies might be involved there. The one thing with pro formas that you want to be careful with is the management consultants and the investment bankers that work on this stuff tend to be extremely optimistic about the amount of cost savings they can get from a merger of these two very large companies. So, when you're looking at the pro forma results at this point, again, take them with a grain of salt. Watch as the real numbers begin to unfold, and Value Line starts to form its complete company coverage. So those are just some thoughts on that. Again, the stock price drop at CVS, I think it's purely intense skepticism on Wall Street. All they got to do is hiccup, and they're basically going to get hammered by Wall Street. So
Mark,
go ahead.
We're getting a question. Could you just explain again that column that you had the arrowhead on, what it means?
Okay, the arrowhead's on a column. It's referring to the position of the stock price between the 52-week low and a 52-week high based on, a stock selection guide trying to place a price out 1 year out. So a number close to 0 would mean that you're close to the 52-week low. A number approaching 100 would mean that the stock price is near its 52-week high, or 52-week price forecast, if you want to think of it that way.
Great, thank you. Thank you much, Mark.
So again, as Hugh has shown many times, he loves to shop for companies that he respects and has followed that are trading within 20% of their 52-week low, and that's just a kind of a feather in their caps. So I'll go ahead and this will be the 11th time that CVS is selected, which will make it the second most frequently chosen stock, second only to Cognizant. And we'll cross our fingers and hope for strengthened management from CVS. They've done pretty well in the past. So with that, Hugh wants to go ahead and double down on his Ardelyx, excuse me. You still with us, Hugh? Are you nuzzling your golden knight?
No, I'm just trying to make room on the shelf. It's a challenge.
Well, you've only got a couple charts here. The first one is just to remind us where we were a month ago when you made your third time selection of Ardelyx at basically $2 a share. And as most of us know, it's done pretty well here in the last month. What kind of update do you have for us?
Well, just to explain to people, I just got back from Europe last night and had to head off for another trip to San Diego bright and early this morning, so didn't have a chance to put anything together. But I do want to pick to Ardelyx again, simply because I think the price is still very low. If everything works out, we'll have a drug approved in July, and we might actually see an FDA review committee. I think that's going to happen, and that would happen maybe in May or even April. But it would happen 2 to 3 months before the approval date. There really hasn't been any news. The only thing that has happened is the partner in Japan has started, I think, a phase 2 trial with their lead drug, tenapanor. So at least they're going to get more clinical information once that is completed. But there's been no other news reported on the company. The stock price went up shortly after that clinical trial was announced on their website.
Now, will the Japanese trials actually be shared with the FDA in any way, Hugh? Is that something that is involved in that?
You can use them for a filing, but I don't think that my understanding is that they don't plan on doing it because they've already actually filed for irritable bowel syndrome, their lead drug. I can't remember what. Excuse me, I got a cold as well, adding insult to injury. I can't remember what the indication was for the Japanese file. I can have a quick look and see. But no, I don't think they'll use it as part of a regulatory filing in the U.S.
Okay. All right, so this will be the 4th time selection of Ardelyx. And again, this is not for beginners. This is a speculative moment for those of you that go and try to do a stock selection guide on this company. You'll discover that to my knowledge, there aren't any E's. So it's not.
That frees you up a bit.
Yep. So this is definitely early stage investing, and one of the reasons.
There aren't any S's either.
Excuse me.
There are no sales either.
Oh no.
So I can confidently say right now 100% of its sales are translating into earnings.
Well,
beat that.
You're buying into ideas and people who seem to know what they're doing. So
yeah.
Again, it's a small part of the portfolio, but again, we're being a bit playful and hoping for outsized rewards.
Mark, we have a couple of hands in the air. If you want to take a couple of questions before we go to the poll. Phil McPherson, I'm going to unmute you. Go ahead, Phil. Phil, you might have muted yourself. You have to unmute yourself, Phil, and then I can unmute you. You're muted twice. While Phil is trying to figure that out, Phil Crocker has a question. Phil, go on. Phil Crocker.
That was a mistake.
That was a mistake. Okay, thank you. Janine Rasmussen. Janine, go ahead. You have the mic. And Janine's must be a mistake as well. Okay, let's go to. Let me get some of these things taken care of here so we don't hear background noises.
Okay. Yeah, I'd say go ahead with the poll, and then we can stick around for a few minutes for Q&A.
Okay. And let's do the poll then.
And again, if you're joining us for the first time, you're eligible to vote. Just simply click on the options that you see in front of you.
Okay. And the poll is now open, Mark.
And while they're doing that, I just wanted to make it clear that I'm available for autographs out on the red carpet after the session.
We had a discussion, Mark, in the Mid-Michigan Model Club when they noticed that for 1 month your portfolio had gone up into 4th place, and they wondered if there were problems with my computer at that point. So I'm just telling you what the general feeling is up around Michigan here, you know.
Either that or it's the 4 horsemen of the Revelation or something.
Well, no, at the last meeting you were down where you belong, so they didn't worry about it at the last meeting.
All was good.
All was good.
Could be related to why they shot 4 on a golf course.
I'm going to keep this open for just about 10 more seconds. We have 85% of our people voting. Just take your mouse and click something if you want to, folks. There, we're almost to 90, so I'm going to close the poll. And I'm going to share the results, and we're going to add 2 Align Technologies to the portfolio.
I'm going to do that.
Yep, that's a good story.
Mm-hmm. Thanks to the little people again.
Yeah, the best.
All right, I'm going to hide this poll, and you can carry on, Mark.
All right, just some coming attractions. Just wanted to note some of the future appearances. Ken and I will be in Chicago this weekend for a half-day session with the Chicago area people, kind of a warm-up for the national convention, which will take place in Chicago in May. All of us will be there in May. We're also going to have a local program at Flint Baker College, April 13th. And Ken and I will visit Pittsburgh just before the national convention on May 4th.
We're looking forward to that.
Yeah, we've always had a great time in Pittsburgh. Love to come out there. Good sessions. Traverse City is scheduled for June. We have an Atlanta date for Kim, Butcher, Ken, and Cy. I believe that's like August 18th. Don't hold me to that one, but it's somewhere in that time frame.
That is August 24th, Mark.
August 24th, okay.
And Mark, you can also add a Heart of Oklahoma for you and myself on August 17th.
Okay, I'll add that for next month. So we do like to get around and get out and see face-to-face. Frankly, it's some of the best times that we have in doing this is the face-to-face sessions that we spend and the quality time that we get to spend with you out there in the community. It really is incredibly valuable to all of us, and we appreciate the opportunities that when you give them to do them. All right, so Ken, that's all I have for tonight. We can stick around for some Q&A if you would like.
Okay, Mark, have you ever heard of anybody being charged to trade an ADR?
charged as an extra money charge, or
A fee to make a trade on an ADR.
I think, don't you pay the same as for a normal stock?
Yeah.
That's my
Yeah,
experience.
stock, really.
We're answering a question from Tom, and Tom says that he has people wanting to add an extra $16 charge on a 100-share trade. That's not my experience, Tom, with my discount broker. But go on, Si. You were trying to get in there.
Yeah, I was going to say that's not my experience either. Although Schwab has, I believe, it's a quarterly charge. It's a relatively small, but it is some sort of a pass through. It's off the top of my head, I can't recall exactly what it is, but I do pay for my ADRs with Schwab. It's a pretty small amount, but there is a fee.
Yeah, I pay a small holding fee from one of my brokers to hold a Canadian stock, but it has to do, I think, with the tax withholding and reporting, and it's in the pennies. It's not anything like $16 or anything like that. So,
exactly. Yes.
But I've never heard of being charged to buy the ADR, and Cy is telling you he hasn't. Hugh is telling you he hasn't. Mark, have you had any experience with?
Neither. Obviously there's sometimes some special dividend considerations and withholdings with ADRs, and I wouldn't be surprised if a broker had a nominal, and by nominal I mean like 20 cents on 100 shares or something on the selling side. In the fine print, when they sometimes will hit you with a tiny little processing fee or something.
Well, there are selling charges for American stocks that you're paying a fee.
Right.
Changes, I think.
And that's what I'm saying. I wouldn't be surprised to see a special charge, perhaps even extra, for an ADR.
Okay, Tom, you use the abbreviation ML, and I'm not sure what that stands for. Anybody, guys?
Merrill Lynch.
Merrill Lynch, of course.
Lynch,
Merrill Lynch. Okay. Mm-hmm. So maybe you need to look at some of the discount brokers that some of us are using, Tom. Okay. I'm getting all kinds of people telling me that they don't pay anything. I'm hearing things like TD Ameritrade, First Trade, Ameritrade, Ameriprise. So there's a lot of discount brokers out there. You might want to switch brokers if they're dunning you $16 on a trade of 100 shares. Don wants to know if anybody has any thoughts on buying AT&T now that the approved merger has gone through with Time Warner.
I've got nothing specific.
No, I don't either.
I think we're just we just don't have any opinions at all. I doubt whether any of us even hold AT&T. Does anybody hold AT&T in their portfolio?
No.
I do not.
Okay,
a member of my church works for them, but
a couple of considerations I would have there, though. I mean, the AOL Time Warner thing didn't work out very well. Again, this is another large merger of equals, and the other thing you've got to at least take a look at in some detail is the amount of debt and the type of debt that you're looking at with both companies, especially AT&T. I'm not saying anything bad. I'm just saying be aware, be knowledgeable about what is actually involved debt-wise.
I'm going to unmute. I think it's Misi Besani. Misi, you're unmuted, but you're muted on your end. You've pressed mute on your side, so I can't unmute you. You have to unmute yourself. Janine, you're back with your hand up again, so I'm unmuting you. Go ahead, Janine.
So did you sell the CBM or the CBRE tonight, whole or total or partial?
We're selling the entire positions in CBM and CBRE, and we'll sell a single lot of ADS.
Okay, didn't understand that. Thank you very much.
Mm-hmm.
I agree.
Okay.
Thanks, Janine.
Okay, Pam, you have a question, and I'm unmuting you. That's my dog. who has just discovered a cat in our backyard. Pam, you're unmuted. Go ahead. Pam Birch.
Actually, Stan Birch. I want to make a comment in support of Cy. I think his position is correct relative to selling lots. If you buy multiple lots of the same stock, you end up with a collection of shares that are all identical. So from an investment point of view, the lots no longer exist. So the discussion of whether or not you sell specific lots doesn't make a lot of sense. That's an issue of a lot of confusion. I just want to say I agree with Cy.
Thank you, Stan.
It's good feedback.
Phil McPherson, I'm going to unmute you. And Phil, you're unmuted. Go ahead. Okay, that must be an inadvertent hand, so I'll put Phil back on mute. And Mark, I seem to have cleared everything out of the question box and the hands in the air. Okay. Oops, here comes a question. Hold on. Meg would like to know: is there a spreadsheet she could use to put all of her stocks from various brokers in one place? Go on. Anybody want to take that one?
We can build one, or I mean, we obviously use a lot of spreadsheets. If you're taking care of personal accounting instead of club accounting, I would highly recommend Matt Wilms's Quant 9 portfolio record keeper, whatever they're calling it these days, for keeping for individual account record keeping. I know that a number of people in the audience, including Ken, I use it. It's excellent record keeping program for individuals.
Yeah, I can't speak too highly of it. Meg, you're getting some tongue-in-cheek answers from folks in the audience, and the gist seems to be, why don't you just move to a single broker, and then they'll do the work for you. So I think that's a little bit cheeky, but at the same time, that would simplify some of the issues. Okay. So Mark, we seem to have everything cleared up here. So I want to thank all of you gentlemen for coming. A special thanks to Nick for showing up, Susan Michelik, Ann in the audience, Ann Manning, thank you for coming tonight. And we'll see you in March for the March version of the Roundtable. Meanwhile, everybody, try to stay warm if you're in the Midwest. Good night, everybody.
All right. Thanks, everybody.
Good night.
Thanks, everyone. I appreciate it.